Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. India is seeing yet another showdown between Twitter and regulators, and the recent one is being played out in the corridors of Karnataka High Court. The microblogging site has challenged some of the government's directives, asking it to take down certain posts. Twitter is not ready to budge, and so is the government. We try to answer why there is a growing unease between the government and the big tech in India.
The confrontation between big tech companies and the Indian government over the country's new IT rules escalated on Tuesday after Twitter moved the Karnataka High Court challenging the IT Ministry's order to remove content and block multiple accounts on the US microblogging platform. According to the writ petition, which has been seen by Business Standard, Twitter contended that many of the blocking orders issued under Section 69A of the Information Technology Act 2000 were overbroad, arbitrary and disproportionate, and failed to give notice to authors of the content. It also said that some were related to political content posted by official handles of political parties, the blocking of which amounted to violation of freedom of speech. Twitter further argued that the content at issue does not have any apparent proximate relationship to the grounds under Section 69A. Hours after the petition was filed, Minister of State for IT, Rajiv Chandrasekhar, said all foreign internet platforms have a right to approach the courts, but they also have an unambiguous obligation to comply with local laws and rules. Twitter would risk losing its safe harbor protection under the intermediary rules if it refuses to comply with the blocking order, while its executives could face jail terms of up to 7 years. Under the IT rules that took effect in February last year, Twitter's chief compliance officer faces criminal liability for the company's non-compliance under Section 69A. Another provision requires strict confidentiality on all blocking requests from the government and actions taken by an intermediary.
The government feels it incumbent upon itself to create a workable safe harbor for social media to work. Now, the question that we have is this safe harbor truly safe? Does it lead to government overreach, state dictating to these platforms what they can post, what their users can post? And then you have very valid questions around freedom of speech. So I think as an intent, it is a good idea to have some kind of federal regulation of social media. But at the same time, we have to make sure that the fine principles behind the intermediary rules and any legislation that may follow should have fair checks and balances. And of course, these actions themselves should be amenable to judicial review. But that does not mean that the executive should have absolutely no ability to supervise at all. I personally feel that it creates a greater risk to platforms to have an opportunistic manner of regulation, which is random judges across states deciding to cherry pick which case fits the bill, which does not fit the bill. We need to have robust checks and balances, which somehow ensure that whatever the executive is doing is thought through. Allegations that sometimes executive orders don't appear to have application of mind, right? Or they may be targeted. So that kind of approach should be amenable to judicial review.
Twitter is not the first tech company to take the government to court over the IT rules. Meta-owned messaging platform WhatsApp had approached the Delhi High Court in May last year, requesting it to quash a provision that mandated companies to divulge the first originator of information. WhatsApp said the traceability rule would break the very guarantees that end-to-end encryption provides and undermines people's right to privacy. The government says that the right to privacy is not absolute and it is subject to reasonable restrictions. WhatsApp claims 500 million users in India, whereas for Twitter, India is its third biggest market although estimates of its users in the country vary from 24 million to 48 million.
Clearly, there's an uneasy relationship between the government and big tech. The reason for this is very clear. The government has suddenly woken up to the immense power of Indian data and therefore wants the intermediaries to become far more accountable in this regard. Intermediaries have had a great honeymoon in the Indian context, where they have virtually been relegated to become mere spectators while mayhem happens on their network. And now, suddenly they find the status quo being disturbed, and they do not want the status quo to be disturbed. That's why these spate of litigations and petitions being filed before courts, so that somehow the status quo can be extended. But I think very quickly, the writing on the wall is crystal clear. And you have no choices but to comply with Indian law, specifically the Indian cyber law. And the Indian government is well within its sovereign rights to insist that all companies who are offering their services to Indians within India ought to comply with Indian law. I hope very quickly there should be some clarity, because there's constant filing of litigations just in the expectation that we will have a lot of time and that we can extend our honeymoon. That phenomenon has to now stop.
Regulations shouldn't just be fair, their enforcement must also appear to be fair. With that in mind, won't the appearance of arbitrariness or bias in enforcement only weaken the government's efforts to regulate big tech?
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
After the government's brush with big tech, let's move on to its policies governing special economic zones, or SEZs, which have delivered mixed results. It is now coming up with a new law to address some of the problems plaguing the SEZ ecosystem. Our next report looks at India's experience with SEZs over the years and the challenges ahead in making the new legislation, if brought in, a success.
Special economic zones were set up to promote export-oriented manufacturing, domestic investments, and improve ease of doing business. Business units in these zones were given a host of incentives, including tax exemptions, duty-free exports, access to better infra, among others. Units in SEZ enjoy 100% income tax exemption on profits from export for the initial 5 years and 50% for the next 5 years. But the World Trade Organization has ruled that these export incentives were against its rules. Nations are not allowed to directly subsidize exports, as it kills competition and distorts market prices. Even though the exports from SEZs increased to 7.59 trillion rupees in FY21 from just 22,840 crore rupees in FY06, it was nowhere close to the success achieved by China. One of the main reasons was the size of the special economic zones in India as compared to China, which has manufacturing zones in the size of megacities strategically located close to ports and trade-friendly locations such as Hong Kong. The competitive advantage that Indian SEZs enjoyed also waned over the years. Several businesses have also moved away from these zones due to alleged lack of consistency in policy. The withdrawal of tax concessions and the sunset clause, along with several ASEAN countries relaxing their regulatory laws, lured these business units to shift shops. The huge parcels of land under the SEZs are also underutilized and lying vacant due to sector-specific restrictions.
Now, one of the important aspects of the SEZ Act was that it promised world-class infrastructure in all these special economic zones. And this would have actually led to kind of increasing exports efficiency and then exports. This was the whole logic. But unfortunately, most of these SEZs did not get the kind of infrastructure that was required. The connectivity from these SEZs to the ports were extremely poor. And as a result, the entire plan, just collapsed. It really didn't give the kind of expected results.
Now, through the Development Enterprise and Services Hub Bill 2022, the government is moving away from the original idea of export-oriented production and is proposing to allow the business units in SEZs to sell in domestic markets more easily and boost domestic manufacturing. The draft bill also talks about setting up an integrated and decentralized single window clearance mechanism for time-bound approvals hubs.
The government is thinking about, improving ease of doing business. But of course, as I said that we've been talking about this for the past 30 years. So the taste of the pudding will be in eating. So let us see whether it gets implemented or not. The second aspect of this being the Desh, all these the special economic zones, being able to sell to the what we once used to call the domestic tariff area. Now, that in a way I feel is an admission that the special economic zones have not been able to export adequately. Now, we have seen in the past as well that whenever the export, their commitments have been they've fallen short of meeting their export commitments, and overall, this thing that there would be a single window clearance that has not happened. We have been hearing this right from the beginning of the economic reform. So 30 years we have heard this. This actually happened. So that's a very important aspect that has to be looked at. But at the same time, I also must mention that a lot of these countries who have been successful exporters and who have engaged in the global economy successfully, they have built their strengths largely through these agglomerations, and this is what the SEZ does provided in many of the Southeast Asian countries. Of course, China is the prime example of this. So agglomeration is really very important, where the SME clusters can be built, and then with all the common facilities and all, the SMEs can actually function more efficiently. So I feel that we have to work on both these legs. You need clusters that have to be promoted, and at the same time you need to ease look at the.
If indeed India needs the special hubs, the government must address the critical gaps in existing SEZ law through the DESH bill, and it must be thought through before bringing it to the parliament. Effective implementation of the law could act as a lever to India's growth.
यार
मत पूछ यार,
फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The revamped law indeed offers hope to 268 operational SEZs of the country. Let's now move on to a commodity which has been threatening to derail economies. West Texas Intermediate, or WTI, crude futures slipped below $100 a barrel mark for the first time since May 11 on Tuesday. Is the era of high oil prices getting over, or was that a temporary blip? From Citi to JP Morgan and Jefferies, analysts have a varied forecast of how they see oil prices playing out. Here's a quick check.
West Texas Intermediate crude futures on Tuesday slipped below the $100 a barrel mark for the first time since 11th of May. It nearly fell 10% in intraday trade before recouping some of its loss. The sharp fall, according to oil watchers, came on the back of concerns that a global economic slowdown would ultimately dent demand. Meanwhile, Citi suggested that oil prices could drop to $65 a barrel by the end of 2022 and to $45 by the end of 2023 in case of a global recession and fall in demand. On the other hand, oil bulls see the prices surging despite a recession. Those at JP Morgan, for instance, see oil prices at $380 per barrel in a worst case scenario if Russia starts cutting crude oil production in response to sanctions imposed on it. Christopher Wood, global head of equity strategy at Jefferies, also expects oil to hit $150 a barrel going ahead amid geopolitical concerns. One way oil can spike higher is escalation of the Ukraine conflict and a resulting decision by Europe to take concrete action to stop buying Russian energy. Such a risk has grown with the reports of atrocities committed by Russian forces and related allegations of war crimes. All of this makes it harder to negotiate a deal, he says. But to what extent is the oil market pricing in all these fears? And is the fall in oil prices temporary? Let's understand this better.
S&P Global Commodity Insights sees dated Brent trading above $100 a barrel through to the end of the year. Now, you've still got a situation where you've had a lot of supply side risks around Russia, around where the extra barrels are coming to come from OPEC plus. But now the market is starting to bake in those recessionary risks. And so we've gone from a supply side risk scenario to demand side risk scenario. And that is helping to curb prices. But at the same time, the market is still tight. The product market is still tight. We see it around with jet and diesel and gasoline, and that has to be worked out. OPEC plus spare capacity is very tight at historical lows. There's only a little bit of wiggle room from Saudi Arabia and the UAE. So, and then you've got the Russia situation. Yes, the lost barrels haven't transpired as the market feared, but at some point, given that India and China have taken extra barrels, but at the same time, whether that continues is going to be harder and harder as the EU cranks up its pressure.
So, all this means that we will continue to pay higher prices for petrol and diesel for now, unless the government cuts excise duty on these two fuels. Technically, here are the key levels you need to watch on MCX crude that trades close to 7,800 rupee mark.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Companies go to the primary markets to raise money through IPO. Some of the IPOs are well received while others are not. A Bloomberg report says that the IPO of Indian startup of business is one of the keenly awaited issues in Asia. So, how do we apply for an IPO? Our next report tells. After a blockbuster run of initial public offerings in 2021 that saw 91 public issues hitting the primary markets, the pace has significantly slowed down this year. So far, Indian markets have seen about 20 companies approach equity markets to raise funds. Global headwinds and several other factors are also responsible for this. But there was an IPO which caught everyone's fancy. It set a record. The number of applications crossed the 6 million mark, something never seen before in the equity markets. A lot of the investors were the first timers. So, we explain the IPO filing process from scratch for the uninitiated here. A company announces an initial public offering in order to raise funds from the securities market. The companies which approach the exchanges with the objective of raising capital, utilize such net proceeds for expansion, repayment of debts, or other corporate purposes. For example, Delivery planned its IPO to raise 5,235 crore rupees, and the company said it would utilize the net proceeds towards the company's organic and inorganic growth initiatives via acquisitions and other strategies. Let's start with the categories of investors. The first category is that of retail investors, where individuals can invest up to 2 lakh rupees. Second are non-institutional investors who wish to apply for an amount greater than 2 lakh rupees. These include high net worth individuals, non-resident Indians, Hindu undivided families, companies, trusts, scientific institutions, and societies. Third are qualified institutional buyers or QIBs. They are commercial banks, mutual fund houses, and foreign portfolio investors. A limit of 50% of the bid is reserved for QIBs. They are not allowed to bid at the cut-off price and cannot withdraw their offers after the closing of the IPO. Fourth are anchor investors who are QIBs and wish to invest 10 crore rupees or more through the book building process. Once done, investors can apply for the minimum bid through online as well as offline method specified in the company's red herring prospectus. While investors need to fill an application form in the offline mode and submit it to their respective banker or broker, online IPO gives investors freedom to upload data through Demat account or via a trading interface. A Demat account allows investors to trade financial securities in a digital format. Then, investors can bid for a particular issue when it is open for subscription. Once they select their preferred lot size, the amount gets blocked through a process called ASBA, application supported by blocked amount, from investors' bank account. This amount does not get debited instantly. Once the shares are allotted by the company, which usually takes up to 10 days, the blocked amount is debited depending on the number of shares allotted to an investor. However, if the issue gets oversubscribed, that is, the demand for the issue is higher than available shares, the allotment is done through proportional basis or lottery system. Now let's understand how to check the share allotment. Investors can check their allotment status on the BSE website or through their online brokerage platform. In order to check the allotment status on the BSE website, investors have to select their respective issue name and enter an application or PAN card number. Once allotted, investors can buy more or sell those shares after the company gets listed in the secondary market.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The IPO of Latent View Analytics was oversubscribed 326 times in November last year. Paras Defence and Space Technologies Limited's IPO comes second in the list of top 10 successful IPOs of the country. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.